Okay, I'm just going to get going. So good morning. Thank you so much for joining us for the first in our four-part summer series on financial services regulatory topics. Our housekeeping rules are to keep your cameras off, your microphones muted, sit back and enjoy the session today, hopefully. Over the next 4 weeks, we'll be covering 4 topics that we either haven't covered before and we think are interesting, and some topics which we've perhaps covered a little bit before, but there's some interesting developments on the horizon. Do feel free to get in touch with myself. Our other speaker today is Marianne, or any of the other Burness Paull Financial Services Regulatory team afterwards if you have any follow-up questions. This session and the others will be recorded and distributed to you afterwards. So let's just crack on with today's session on the UK's consumer credit regime. So let's get right back to basics. What is the consumer credit regime and what does it do? There's 2 main pieces of primary legislation which have been amended by various other secondary legislation and regulations over the years. So we've got the Consumer Credit Act 1974 and the Consumer Credit Act 2006. And the 2006 Act didn't replace the 1974 Act, but rather amended it. Also there has been a lot of the Consumer Credit Act that has since been repealed, but parts of it and its secondary legislation have been retained. For example, the regulations relating to the form and content of agreements and pre-contract disclosure, which we'll come on to discuss a little bit later on. Also relevant is the Financial Services and Markets Act, FSMA, and its secondary legislation. And in particular, there's the Financial Services and Markets Act Regulated Activities Order, which we call the RAO, and the RAO sets out what constitutes regulated consumer credit activity. And this was previously set out in the CCA. We've then got the FCA Handbook, which sets out the rules and guidance for credit-related regulated activities, and the relevant source book in the handbook is known as CONC. It gives detailed guidance for firms in terms of how they conduct business, promote activities, and communicate with customers. The FCA is now the regulator responsible for the regulation of consumer credit. So the slide there just sets out what I've just discussed in terms of the legislation and guidance. So what is the purpose of the legislation, accompanying regulations and rules and guidance? Well, the purpose is to provide the regulatory framework for certain types of contract relating to credit, hire and ancillary credit business. And we refer to these type of contract as regulated agreements. But the consumer credit regime only provides protection for a certain category of persons, that is consumers. So if we just go on to the next slide. Okay, so again, we're sticking with the basics. What is credit? So credit can be a cash loan and any other form of financial accommodation. And there's different types of credit. So we've got running account credit. So for example, that's your credit cards, overdrafts, store cards, revolving credit facility up to a certain limit. And these examples, you can keep running up credit until you reach your limit. We've also got fixed sum credit. So as it sounds, a fixed amount of loan, usually repayable in one amount or installments. And examples of this are hire purchase agreements, a loan agreement from your bank. So that's the meaning of credit, but who is protected by the consumer credit regime? So if we go on to the next slide, please. So to qualify as a consumer, we have to have an individual to the agreement. Now, the definition of individual is wider than just a person. So it can be a natural person. It could also be an unincorporated body of persons not consisting entirely of body corporates, or it could be a partnership of 3 or less. So credit agreements with companies or other body corporates are therefore not regulated agreements, under the consumer credit regime, because if there's not an individual involved. And the lender under such agreements will not need to be authorised by the FCA for consumer credit activities or follow the stringent rules and regulations associated with consumer credit agreements. So a consumer credit agreement will be where the creditor provides credit of any amount to an individual. Another type of regulated agreement under the consumer credit regime is a consumer hire agreement. And to fall under this definition, it must be an agreement made by a person, an agreement made by a person with an individual, so the hirer for the bailment or hiring of goods to the hirer. That agreement must be capable of subsisting for more than 3 months, and the agreement cannot be a hire purchase agreement. And carrying on or agreeing to carry on any regulated consumer credit activity will only be a regulated activity if it is carried on by way of business. Sometimes this can be relatively easy to establish, other times less so and needs a little more analysis. Okay, so if we go on to the next slide. So I'll come on to discuss what it means to be caught by the consumer credit regime a bit later. And we'll see that it is a very prescriptive, perhaps restrictive regulatory regime. But there are exemptions, and if an agreement can meet the requirements of an exemption, then it will not be subject to the consumer credit regulatory regime. So just looking at a couple of examples. One that we see quite often is the business purpose exemption. And to qualify for that, the agreement must be wholly or predominantly for business purposes, must have credit or payments that exceed £25,000, and the debtor must provide a declaration. And this prevents the creditor declaring that the business purpose exemption is applicable when in fact it's not. So another exemption that I've listed on this slide, there's high net worth exemption. So to qualify, the agreement must have credit in excess of £60,260. The natural person who is the debtor must have income not less than £150,000 or net assets not less than £500,000. There must be a statement of high net worth made by a UK qualified accountant or creditor, or it can be the creditor if the creditor is a bank. And a copy of that statement must be provided to the lender before the agreement is made. And the agreement itself must include a declaration agreeing to forgo protections of the Consumer Credit Act. Another example of an exemption, which is quite often relied on by buy now, pay later providers, is the Article 60F2 exemption. So this is where there is a borrower lender supplier agreement for a fixed sum credit. The number of payments to be made by the borrower is not more than 12, and those payments are required to be made within a period of 12 months or less. And the credit can either be secured on land or provided without interest or other charges. And another exemption, this is the final one that I've got listed there, is the regulated mortgage contracts. So these fall within the FCA's mortgage regime rather than its consumer credit regime. And so mortgage contracts are categorised as exempt agreements under the RAO. Okay, so if we go on to the next slide. So why is it important to know when you're dealing with a regulated credit agreement? So as I'd mentioned, the Consumer Credit Act sets out very specific requirements. These include specific information must be given to customers before a regulated agreement is even entered into. So that's known as pre-contract consumer credit information, or PCCI. The form and content of the regulated credit or hire agreement itself is fairly prescribed, so the information must be presented clearly, particularly information around fees and charges. There is certain information and rights to be given to customers during the entire lifetime of the regulated agreement. Any terms and conditions must be adequately explained. And a copy of the agreement must be sent to the customer to consider before signing, so that the customer properly understands the agreement they're entering into. There are also prescribed time periods to receive certain documents. And there's also certain rights to withdraw or terminate the agreement. This will be dependent on whether it's a credit or hire agreement. So for some credit agreements, there'll be a right to withdraw within 14 days. Some hire agreements, there'll be a right to terminate after the agreement has run for 18 months. And with all credit agreements, there is a right to settle early with rebate in certain circumstances. So once signed, the executed agreement and any other documents referred to in the signed agreement must be provided to the debtor. The exception to this is where the debtor already has a copy of the unsigned agreement and is identical in terms. But in that instance, the creditor must inform the debtor in writing that the agreement has been executed and that the debtor has the right to receive a copy of the executed agreement if requested. And I'm just going to finish up on, if you remember one thing today, if you're not already aware of it, remember Section 75 of the Consumer Credit Act. Well, we still have that section subject to any future reform. So Section 75 is why you are advised to pay for high value items on your credit card. Section 75 allows for where there is a debtor, creditor, supplier agreement, and that's under Section 12B or C of the Consumer Credit Act. So where a customer has a claim against a supplier for misrepresentation or breach of contract, they also have a like claim against the creditor. So the creditor and supplier are jointly and severally liable to the debtor. It applies to purchases over £100 but less than £30,000. So this means that, for example, you buy a laptop, you order a laptop to be delivered from an online electronic provider, say that business goes bust. Ordinarily, you would have no recourse for your undelivered laptop if the business is no more. However, with Section 75, you're able to raise a claim against the creditor, for example, your credit card company, if you'd paid for it with your credit card, for your missing goods. So that would be your breach of contract claim. So now I have given you an overview of the existing consumer credit regime. We're now going to look forward to what the proposed reforms are and changes to the current regime. And for that, I will pass you over to my colleague, Marianne.
Thanks, Sylvia, and hi everyone. So hopefully that's provided you with a high-level understanding of the consumer credit regime as it currently stands in the UK. I'll now turn to look at what changes we can expect to be made to the regime over the coming years. And it's fair to say that the consumer credit market has been an area of supervisory focus for the FCA since it took over responsibility for regulation from the Office of Fair Trading back in 2014. So this scrutiny became more prevalent and will continue to do so as a result of the pandemic and the current cost of living crisis, driving greater demand for credit, including short-term credit, and impacting consumers in vulnerable circumstances in particular. There's also a recognition that an increasingly digital world is making it far easier for people to access credit, and there are many new and emerging products on the market which are outside of the current scope of regulation. And the fact that they're not currently regulated means that they may cause consumer harm. So it's against this backdrop that the FCA's board commissioned a review of the unsecured credit market back in September 2020. This is known as the Woolard Review, which you might have heard of. The Woolard Review examined the unsecured credit market and the extent to which there may be a need for further regulation. The report made 26 separate recommendations to help make the unsecured credit market fit for the future. And I'll spare you the detail of all of the recommendations made, but generally the report was very much consumer outcomes focused. The report's most striking recommendation and the one that garnered most comment was the recommendation that new and currently unregulated products should be brought into the scope of consumer credit regulation. And these products are those known as buy now, pay later, which Sylvia briefly touched on. So what are buy now, pay later products? You might already know or have used them, but these are products offered by companies such as PayPal or Klarna, which allow customers to delay or spread the cost of a purchase. The buy now, pay later provider is usually paid a portion of the purchase price by the retailer. And while interest is not payable by the customer, there are late payment fees and a consumer's credit rating can be affected. Buy now, pay later has become increasingly popular. It's now being used by consumers for things like grocery shopping and even takeaways. And a figure from last year showed that 30% of consumers in the UK has used buy now, pay later to pay for goods. And among those, almost 1/3 said that the lending had got them into problem debt. These types of products tend to be favoured by those with poorer credit records or who are financially vulnerable. And Woolard recommended in his report that these products be brought within regulation as a matter of urgency. I'll come on to discuss how these will be regulated shortly, but just before I do, I wanted just to touch on another product which was referenced in Woolard's report, and these are employer salary band schemes, which are becoming increasingly popular. These schemes allow consumers to access a portion of their wages before their payday, usually in exchange for a small fee, and they're also unregulated at present. But in his report, Woolard, he didn't call for these schemes to be brought within regulation, but did suggest that the FCA encourage providers to draw up a code of best practice. And these will likely be one to watch for the future as they continue to gain momentum. So in terms of buy now, pay later regulation, the Woolard review provided some context as to why these products are coming under regulatory scrutiny, but where have we got to since the report was issued? Well, following the review, it was announced by the government in February of 2021 that interest-free buy now, pay later products would be regulated. The government published a consultation on the draft legislation in February of this year, which is now closed. And some of the main concerns cited for the need to regulate buy now, pay later products were that consumers often don't view these products as credit and associate them more with payment technologies. There's also a lack of proper affordability assessments and the potential to create high levels of debt. And the buy now, pay later market structure focuses more on outcomes for the retailer rather than the borrower, which obviously deviates from this kind of very consumer-focused world that we are trying to move towards. So as Sylvia outlined earlier, the UK regime generally requires businesses lending to consumers to be FCA authorised. However, at present, there is an exemption from FCA authorisation for consumer credit-related activities where credit's provided on an interest-free basis and on terms of repayment in 12 or fewer instalments and within 12 months or less. So buy now, pay later providers currently rely on this exemption, which is the Article 60F2 exemption. And this means that at present, those offering these products don't need to be authorised or regulated by the FCA, nor do they have to comply with the requirements of the Consumer Credit Act. So the draft legislation proposed by the government substantially curtails this exemption, with the effect that buy now, pay later agreements offered by third-party lenders will be regulated credit agreements, and such lenders will therefore be required to be authorised. Specifically, borrower-lender supplier agreements for fixed sum credit to individuals or relevant recipients of credit, which could include some small businesses, will become regulated where they are interest-free and payable in 12 or fewer instalments within 12 months or less, provided by a person who is not the provider of the goods or services that the agreement finances, so i.e. a third party and not the merchant, and is not otherwise exempt. The government is careful to avoid impacting certain established types of credit which currently fall outside of regulation, but it believes that there is little to no risk of consumer detriment in the absence of regulation. So accordingly, the draft legislation includes specific exemptions for credit arrangements, such as interest-free arrangements to finance contracts of insurance and employer-employee lending. And under the new proposed regime, lenders offering buy now, pay later products would need to be authorised and would then therefore need to comply with the various regulatory requirements and consumer credit rules, including the upcoming Consumer Duty and the Financial Promotions regime. And of course, the FCA would then also be able to take enforcement action against any firm that breaches its rules. The consultation period for the draft legislation expired on the 11th of April of this year, and once the government has considered stakeholder responses and made any required changes, it will then lay the legislation before Parliament. And the government proposes to put a transition period of 2 years in place to allow the regulator to finalise its rules for the new regime and for firms to make the required changes to their business models. So just moving on to the next slide, I will briefly touch on the CCA being reformed. So on 16th of June last year, the government announced its intention to reform the Consumer Credit Act, which might not come as a surprise to many, given that the regime is 50 years old. The Act, or the CCA, was enacted after a study of the consumer credit market by a committee which was appointed in 1968. And as you can imagine, a lot's changed since then. Credit cards as a product were in their infancy and digital platforms hadn't yet been invented. At the time, the real concerns were around doorstep mis-selling of loans by agents and canvassers. And the way that consumers interact with credit products has clearly evolved significantly. Further, back then, there was no regulator to keep the market in check in the 70s. The CCA was designed to work on its own as a self-governing body of law. And this is obviously no longer the case since the FCA took over regulation of consumer credit from the Office of Fair Trading. The FCA therefore now has wide powers to sanction non-compliant lenders and brokers. And what's more, the current regime has been criticised for being highly prescriptive and increasingly cumbersome and inflexible. These factors, coupled with the UK's departure from the EU, all contribute to a strong case for reform. So with that history lesson over, what will change? Well, the government plans to move much of the Act from statute to sit within the FCA handbook instead, and the rules will be recast rather than replicated. So this will allow the FCA to respond quickly to any emerging developments in the consumer credit market, rather than having to go through the process of amending existing legislation. The new regime aims to simplify ambiguous technical terms to make clearer to consumers what protections they have and make it easier and more cost-effective for businesses to comply with the regulations. And HM Treasury's consultation to reform the CCA closed on 17th of March this year. And following the consultation, the government has said it will provide a summary of responses and set out next steps. It will no doubt have a lot of responses to consider, and we likely won't hear anything until later on this year. So finally, if we move to the next slide, I just wanted to briefly touch on the FCA's consumer duty, which is a new principle which will be enacted by the FCA shortly. And the aim of the duty is really to set a higher standard of consumer protection in retail financial markets for firms to adhere to. So the new rules will apply to all regulated credit-related activities. And as part of the duty, there will be a new consumer principle that will require firms to act to deliver good outcomes for retail customers. It's the FCA's aim that the consumer duty reduces the extent to which consumers suffer harm, with firms doing more to consider consumer needs and to take action to guard against problems. And this includes avoiding consumer harms such as the exploitation of consumers' behavioural biases, so-called sludge practices where firms can make it harder for consumers to act, for example, by putting in extra steps before they can switch or complain, and non-deliberate exploitations arising from a consumer's weaker bargaining position in credit agreements. The consumer duty rules will apply from 31st of July 2023 for all new products and services and all existing products and services that remain on sale or open for renewal, so it's just around the corner. And it will apply to all closed products and services from 31st of July next year. So that takes us to the end of our webinar. It's certainly an exciting time within the consumer credit space. There's clearly lots of change in the horizon, but I'm sure you'll agree that much of it is required. So thank you for joining. I hope you found that interesting. If you do have any questions, then please feel free to drop Sylvia or I an email. We'd be happy to help. And we hope to see you next week, where we'll be discussing the FCA's cash rules.